The misunderstanding of AMT has caused thousands of employees to bolster hefty tax bills. And lucky for you, it might not be too late to prepare for and avoid AMT. I'm going to cover what AMT is, how it gets triggered, and most importantly, how to avoid it when exercising your incentive stock options. First, let's start with AMT and what it means. AMT is an acronym standing for Alternative Minimum Tax. It was created to curb any abuse of the income tax system. At the time, the wealthy were implementing income tax planning strategies that helped them completely avoid paying income tax. The alternative minimum tax was a way to get the wealthy to pay their taxes by creating a floor of minimum taxes. Although intended for the wealthy, on occasion it overreaches and subjects middle income earners to AMT. And unfortunately, this is really common for those that exercise their incentive stock options. This is AMT. This is a tax calculation that all taxpayers have to calculate. In addition to your regular tax liability filed on Form 1040, the AMT is calculated on Form 6251 and it's considered a parallel tax calculation. As a taxpayer, you're required to pay the higher of the two. By decreasing your tax liability, you're actually increasing the chances that you pay AMT. Do you see how this catches the tax planners who try to avoid paying income tax? So how much does your AMT increase by exercising? Your AMT is increased by the bargain element, which is the spread between the grant price specified in the grant document and the fair market value on the date of exercise. So if you own lots of ISOs and you start exercising them, that spread could exceed the amount of regular tax liability, therefore subjecting you to AMT. The problem is when you exercise your incentive stock options, that increases your AMT. This increases the chance that your AMT liability is going to be higher than your regular tentative tax liability. And because exercising large amounts of options usually relates to large sums of money, your AMT skyrockets. The huge AMT tax bill wouldn't be a problem, except for the fact that you can't always sell your shares to help pay for that tax bill. So if you don't have the cash to pay for it, you're in trouble. This is an actual stock option. Just remember that a stock option is just a contract between you and the company. When you exercise the contract, and in return you don't get a large sum of money, you get shares. When you have an AMT liability, you don't have a large sum of money to help pay for the AMT liability, you have a bunch of shares. And you have to sell those shares in order to get money, but because you can't always sell when you want to, it creates a big problem. There are many stories of people who exercised a massive amount of stock options. They got a huge AMT bill that was larger than their net worth, larger than their salary, and they couldn't afford it. It just goes to show that you gotta be careful about how you exercise your incentive stock options. They could pay for it if they could sell their shares, but because they can't always sell as owners of private equity, they can't afford it. You generally have to wait for something like a tender offer or some sort of liquidity event in order to sell your shares. Unsuspecting people who exercise a large amount of options end up having to forfeit all of their shares and their options because they can't afford the AMT tax bill. So what can you do? And the answer is you can prepare in advance. So let's discuss some of those strategies. First, let me start with a word of caution. Implementing these strategies requires professional help. So please don't do this without the help of a professional. Okay, now we're on to the strategies. Let's compare AMT to a window. If you go through it, you have to pay it. If you go around it, you don't have to pay it. And there are three main ways to do this. First is overshooting AMT, the second is undershooting AMT, and the third is going around AMT. First, let's start with overshooting AMT. The concept here is to increase your regular tentative tax to be much higher than your AMT tentative tax. Remember how you pay the higher of the two? The first way to overshoot the AMT window is something called income shifting. This is where you shift the income into the year that you think you may become subject to AMT to the point where you have so much income that year that you don't have to pay AMT. This is really only applicable when you have the ability to shift income into a specific year through something like commissions or bonuses or capital gains. So if you're closing a big deal that's going to give you a huge increase in income for the year, you might consider closing that deal the year that you're trying to avoid paying AMT. This only makes financial sense if your income tax bracket is lower than the AMT rates, which there are currently only two AMT rates, one at 26% and the other at 28%. So if you're in the 22% tax bracket or below, then this makes financial sense to save your income for the year that you're exercising your incentive stock options. For example, if you're in the 22% tax bracket, it makes more sense to pay 22% than it does to pay AMT's 26%. If you'd like some helpful tips regarding your AMT situation or incentive stock options, you can schedule a free appointment with myself in the link down below in the description. This offer is subject to availability, so schedule an appointment before they're all gone. The second way that you can overshoot the AMT window is through something called deduction clustering. Rather than taking tax deductions the year that you're trying to increase your income to avoid AMT, you should delay those tax deductions and cluster them together for the year that you sell your shares, also known as the year of disposition. These delayed deductions can then be used to keep you from higher tax brackets the year of disposition. This helps you save on taxes for 2 distinct years. The first year, the year that you're exercising, because you're not paying the higher AMT rate. And then also the second year is when you're selling the shares. Having those deductions will decrease your income tax liability and keep you from paying higher rates. The second way to avoid AMT is through undershooting AMT. This is the same concept as overshooting your AMT, but this is essentially focused specifically on decreasing your AMT, whereas overshooting AMT was dealing with increasing your income. The first way to undershoot AMT is through exercising sooner rather than later. Please share this video in your Slack channels or LinkedIn because your coworkers need help with this too. Timing can play a huge role in avoiding AMT. Remember that the AMT that you pay upon exercise is the bargain element, or the spread between the grant price and the fair market value on the date of exercise. When a company is young, it has a low valuation, meaning that bargain element or that spread, it's paper thin. That tiny bargain element might not even trigger AMT. And in the case that it does, it'll be much smaller than when that valuation grows and that spread grows with it. If you wait to exercise, that means that the company has more time to grow in its valuation, and thereby the bargain element also grows and your AMT grows. So if the business grows, your AMT grows. No celebrating company growth until your AMT is figured out. The other way to undershoot the AMT window is through a strategy called AMT crossover. This is where you exercise at the very end of the year, knowing exactly how much you can exercise without triggering AMT. At the end of the year, you'll have a pretty accurate picture of what your income tax situation will look like, therefore making it much easier for you to know how much to exercise and not trigger AMT. This works great for exercising over several years, like in accordance with a vesting schedule, versus just exercising everything in one large lump sum. This will take some serious planning to get it right, so here's my friendly reminder to work with a professional. The last way to undershoot AMT is through something called early exercise. An early exercise is where an employee exercises their shares before they even vest. Not all companies offer this, so make sure that you check your grant document to see if this is applicable. If you can and choose to early exercise, you should look into the 83B election. This is where you freeze the bargain element for AMT purposes. Just note that this must be done within 30 days of early exercise. The 83B election doesn't normally apply to incentive stock options. This is the rare case where it does, and it only works with unvested shares. Early exercise only makes sense if you're one of the first few employees of a company that's less than a year old. If you truly are one of the first few employees of a startup, you should look into the tax benefits of qualified small business stock. I discussed this in another video, so you can find the link in the description below. The last strategy is going around AMT. The concept of going around AMT is just finding ways to eliminate AMT without actually having to manipulate your tax liability or tentative AMT. First, let's look into disqualifying disposition. This is where you sell your shares in the same year that you exercise. When you sell your shares in the same year of exercise, you disqualify your incentive stock options and they effectively become non-qualified stock options. And because AMT only applies to ISOs, you practically just sidestepped AMT. You need to weigh the benefits of this one carefully. So while you may have avoided AMT, you also lose the benefits of incentive stock options. And those benefits are long-term capital gains rates and the avoidance of payroll tax. This strategy works best for employees of public companies that exercise at the beginning of the year. And why is that? That's because when you exercise at the beginning of the year, that gives you the whole year to decide whether or not to sell your shares to avoid AMT. Employees of public companies, they have liquidity. And that just means that they can sell their exercised shares quickly and easily if they need to. Meanwhile, private companies aren't so liquid. If that opportunity to sell doesn't come, then this strategy just failed and you have to pay AMT. So that's why it's recommended for employees of public companies who exercise at the beginning of the year. This has to be a calculated risk because if done wrong, it could mean paying more in taxes. So you should work with your tax accountant or financial planner to hone in on this strategy. The last way to avoid AMT is through something called the offset method. When you exercise your incentive stock options, your AMT goes up. When you sell those shares, you get an AMT credit, bringing your taxes down. So if you overlap exercising some shares and selling other shares in the same year, your AMT could be offset. You're effectively using the tax credits of previous AMT tax liability paid to help offset future AMT liability from exercising shares. This makes exercising so much more affordable, knowing that you can manipulate the taxes in your favor. So those are two ways to go around AMT, and the one thing that I don't want you to go around is going to be that subscribe button. Go right on through that subscribe button. In all seriousness though, it could help me out a bunch for all the time and effort that I put into creating this content. Now what if you become subject to AMT? If there's no way around AMT and you have to pay it, that stinks. But there's another planning opportunity, my friends. Here's a way to save on AMT taxes if you're in the higher tax brackets. The highest AMT tax rate is 28%, while the highest ordinary income tax rate is 37%. For a year where you have to pay AMT, any additional income will fall under that AMT 28%. So let's say that you're in the highest tax bracket of 37%. If you have any other income that could fall under AMT, such as non-qualified stock option exercises, a large bonus, or any other selling of short-term capital gain items, then it'd be advantageous to shift those things into the year that you pay AMT. Then they'll be taxed at the 28% rather than the 37%, thereby saving you 9% on taxes. This is effectively sheltering your income from higher tax brackets in the year that you have to pay AMT. If you're wondering when to exercise your incentive stock options, watch this video here.